Good morning, everyone. In this video, I'm going to take you through my process of setting up options plays on 4 particular stocks, all in a bullish light. Particular member, Danny, if you're watching, was interested in this process, and so I thought it would be interesting to document this. Keep in mind, this is going to be a lot more raw, uncensored. Most of it may sound like I'm speaking to myself, but hopefully that helps to give you some sort of insight into what I look at. And this isn't to say this is the right way. I think there's lots of different ways to trade options, especially if you start to read some of the more old school books in terms of the ones that teach you how to use the Greeks and just the core component of thinking of options as 4 puzzle pieces. You'll notice that there's so many different multi-leg strategies that you can incorporate that fits your own trading style. This video will be to document how I look at options, and then I also have one script that I've shared, which hopefully is useful even if you don't look at options the same way as I do. All right, so the 4 stocks that we're going to set up these plays in are Microsoft, Facebook, Delta Airlines, and ZYXI. You should notice that all 4 of these stocks are across the spectrum. So Microsoft and Facebook are a little bit more of your conservative plays, right? They're a little bit safer. That's where I've said I don't mind owning shares at a lower price. So for those of you already familiar with options, you should already know where this is going in the idea of selling puts to try and own shares. But again, we're going to set these plays up and then also try and see if there's any defined risk plays that we can find in Microsoft and Facebook. Then in the case of Delta Airlines, that's where we have a recent new uptrend. We also have high IV, and so we'll see if there's a way to take advantage of that high IV. And the reason for choosing Delta is relative sector strength in the airlines, along with Southwest as well, in case you're looking for another play here. And then finally, there's a stock that's been appearing in the IBD 50 list for quite some time, along with some of our scans, along with it's hit our live scanner tab on the volatility box page. And so there's just lots of reasons why it's been on the radar, and that's ZYXI. If you take a look at it, you'll notice that the stock's been on a nice uptrend. Also has high short interest percentage, 18%. And so that's where this is going to be our most aggressive play, where we're looking for that really nice exponential move up higher. Delta Airlines looking for a more lottery ticket type play to take advantage of this high IV, but also some more consistent plays if we can find any of those, more stable grind, higher type moves. And then in Microsoft and Facebook, I'd like to see if there's a way to, again, just collect the premium based off of this recent burst in the VIX off of our recent sell-off, right? Take advantage of the implied vol moving up a little bit higher in some of these stocks to try and collect a little bit more for selling some of those puts, and then some other type of plays in Delta and ZYXI. The end goal will be to have a theta positive portfolio. I've just been on the opposite side of theta where every time I try to fight time, it screws me over. So I'd like to make mine a positive portfolio this time around. And then with a positive directional bias. On the overall, I think that these stocks do have a little bit more room to go up higher, but I'm still cautious with the rally that we've had. So I'd like to have, again, a focus on only 4 stocks and a fairly limited risk approach where the dollars that I've put out there are limited. And I think only Facebook and Microsoft are going to be the ones where you have a good amount of buying power that's taken. Now, before we go to the options tables and the scripts, let me just go through a quick review of the Greeks for those that aren't familiar. The first is of time decay, and that's our theta. The 2 things that I'd like to highlight here is one, theta decay is a very real concept, and I think many of you, at least I know I've been on the other side of it, where I've thought that a move is really going to start to happen, say within 30 days, but 14 days later I find myself with the stock having chopped sideways, and that call has just eroded in premium. And so that's where we'd like to be theta positive. We also know that the theta starts to really increase rapidly inside of that 30-day mark. But also argue you can maybe stretch this out to 45 days because that's where you can start to sell these options where once you hit the 30 days, you're already in it to try and take advantage of this particular inversion point. And then particularly for those of our volatility box members, there's a couple ideas around day trades. The first is you'll notice that for shorting some stocks that are hard to borrow, there's few ways to play it. One way is to use the shorter date to expiration puts. This is where you can still do so, play the bearish move in a more affordable format without needing to overpay for time, the time component, excuse me, because you plan to get out the same day. So that's where days to expiration doesn't really matter. And another one, which these two are a little bit more creative, which is particular for Fridays, where you can sell the 0 date to expiration credit spreads, and usually here you'll get much more than a 1-to-1 risk to reward. And so that becomes really interesting because you've skewed the risk to reward in your favor, especially if you get some of these volatility box entries where the stock has, say, fallen into our price ranges early in the mornings. You sell a credit spread against our levels, looking for this move up higher. That's where you collect a lot of this premium much, much quicker on the way up higher, and you get to pocket that change quicker and use Fridays and this time decay in your favor one more time with 0 days to expiration. Another way to do that if you prefer to buy premium is using the zero date to expiration options, but the out of the money ones. And the target price, this is where the gray target line, wherever that stock is, that ends up dictating the strike price for the out of the money options. And that again, if you do get this move into the out of the money options, the out of the money becomes in the money or at the money. And that's where you have a really nice move up higher in terms of the actual options premium component. And you have the zero days to expiration working in your favor in terms of a very low risk trade. So those are two clever ways to try and use the Friday options and this time component in your favor on Fridays with a tool that kind of live scans every 15 seconds. Then you know exactly on Friday, say by 7 or 8 a.m., these are the plays in which you can try and find some option setups. The next component that we have is implied volatility, which is really uncertainty is the layman's terms of that. And so high IV means more uncertainty, which means your premium is more expensive. And so typically if you're then going to be buying options, you know that you're paying for something that's already more expensive and you're banking on it going even higher. And so I think in such scenarios, it's probably smarter to try and sell that premium, right? Sell something that's more expensive instead of buying that. And in a low IV environment, that's where there's low uncertainty, you're banking on this volatility expansion, right? More uncertainty entering the market and the premium starting to expand from wherever you are. And that's where you'd like to be long Vega. Now, the script that I've written, which I'll share, it's in the description box as well, is around being able to compare now the options price, the actual closing of the options price from, say, today to 5 days ago. And the reason I chose 5 days for this exercise is that's Monday of last week before we had sort of the sell-off. And so you'll notice in most stocks that ends up becoming the peak. You can tweak that variable if you'd like to change it from 5 days to whatever else. But then this tells you that, okay, in the case of the SPY options here, the SPY 304 call is 44% cheaper today. So it's lost 44% of its value from 5 days ago, right? And the same way, if you look at the puts, you'll notice that the puts have increased in value by 153% relative to what they were on Monday. And so that's where I think just if you were to try and scan this, you can very quickly understand, well, how much more are you paying? And use this as a percentage basis, which I think is just a little bit more understandable to our normal human brain. Right? And so that's the script that I've written here. We'll look at that when we get to our charts. In the case of SPY, you'll notice it goes straight down. But for some other stocks, we'll notice that you'll see some loading errors as well. Now, with what do we know? Another one we have is our delta, which is our directional exposure. And that's where just very quickly, for every dollar the underlying stock price goes up or the ETF, the option will go up by X dollars of that delta per share, right? So like the 51 delta would be 51 cents per share. And so that's the way to look at delta. And if we combine all these pieces, you have four different puzzle pieces that you have from essentially the four moves you can make. The first is buying a call. The second is you can sell that same call. The third is you can buy a put. And then the fourth is you can sell a put. These are the four pieces. Now you can combine them any which way you want, but whichever way you combine them, these are the Greeks associated with each one. So hopefully this serves as a good guide. So for example, if you're buying a call, then you know you're fighting time decay, so your theta is negative, but you have long directional exposure, and you also have long volatility exposure, and you're also long gamma in the sense of your rate of change in delta. And I'll make this particular slide available as a PDF download guide. And so if you'd like to print it out or whatnot, it serves as an easy reference guide if you are ever confused in terms of what Greeks are associated with what position. So for example, one more before we talk about this is why is buying a call debit spread so useful? Well, in my opinion, it's useful because in buying a call, you're negative theta, but in selling a call, you've now been able to offset that same component by at least a little bit of that theta component, especially if you choose two strikes that are relatively close to one another. Now, of course, in that trade-off, you've also given up your delta, your vega, and your gamma, and that's where we see that this then suddenly does start to cap your profits, but you can ask yourself whether or not this first link being able to offset your theta risk while having a fairly clean long position is worth it. And I think to me, more often than not, my answer to that is yes. So you'll notice a play that I set up often in the exercise today is just your simple buying the at the money call debit spread or at the money put debit spread, especially if you have your IV percentile that's suggesting that you're in the lower implied volatility range. So if we start with the chart of Microsoft, let's start by expanding the daily chart first before we look at all the squeezes and all that good stuff. So starting with our swing high to our swing low, we're still on our way to our 1272 extension, which to me I say looks like Microsoft has room to go to try and hit it, which is at 206.46, especially when you start to look at stocks like say Peloton, which have already hit their 1618, and then you have other tech stocks as well, which have currently hit their 1272. I say, okay, there's a chance that Microsoft hits it, while other stocks may continue to go even beyond their 1618. I'd like to play the move of Microsoft into this sort of what I consider non-extended move, right? Into the 1272 is still, it feels a little bit better compared to trying to play something that's going from its 1618 to the 200 extension now, for example. And so that's where I'd like to look at Microsoft as a potential play setting up. We're also bouncing into a place of support based off of previous Fibonacci retracement. So if I zoom in just a little bit closer here, if we compare this swing high to this swing low, and then this swing high and this swing low to where our current swing high is, you'll notice that we've bounced into that sort of cluster zone of 184 to 186. And that's another reason why you may be looking at Microsoft to start to bounce from here. For those of you that do have access to it, I've found that using the 1 hour edge signal here is a pretty good indication where you don't enter too late, where once you get that bullish arrow, once you bounce into one of these Fibonacci zones, that becomes your trigger signal to get into the trade where you're still able to get close enough to the what would be your stop really, and still be able to play this move up higher. And so that's the 1 hour edge signal arrow as your confirmation from these Fibonacci zones, which is then your time to get into this trade. And if you don't get that and you end up breaking outside of these zones, well, your capital is spared at that moment. So now if we come back to the daily chart here, which is what we were looking at, the chart looks good overall on the daily chart. Let's now see where we have some opportunity setting up. So with the squeeze, we have multiple squeezes setting up. So we have the 3, 4, 5 minute normal squeezes, your fast compression on the 10, 15, 20. Again, normal squeeze. So basically squeezes all over the place. For the most part, you have momentum that's above zero outside of your 2 hour, 1 hour, 30 minute, 20 minute, 15 minute, 10 minute. Of course, these look like they may be starting to change, but your 2 hour, 1 hour, and 20 minute all suggest that you may have this sort of grind up move higher, and Microsoft may still very well see lower. Right, so now if I come to the daily chart, expand this to focus on before we get to the options chain, then in terms of being able to buy the stock at somewhere closer down here, like say 165, near that 50% retracement zone, sounds like a much better idea, right? I would be a happy buyer at 165. And if you're saying that I can still collect some sort of premium, some sort of money for saying that, yes, I'm willing to buy where our 200-day moving average is, the halfback level of this move in which I think we're already going to be bouncing from here, then that seems to me like a pretty low risk, nice way to just collect some premium. So coming in Microsoft's option chain here, the way I can now start to use the script, which actually if I first open that up so you can see it, that's pricing. What you'll notice is it's just two very simple conditions, right? So the first one up here is if you wanted to see what the pricing was in relation to the stock price, which this is more that IBD approach where you want the at the money to be less than 4%. That's what this helps you do. I've commented that out because the condition I currently care about is just comparing it to 5 days ago and seeing, well, what is the close price of that as a percentage basis and plotting that. And so now if I am looking at trying to sell puts, I would want to say come out to something like 33 days, right, where I want to be inside of that 33-day window to capitalize on the state of decay. And maybe let's see what all the option strikes look like. And here you can see that, okay, first we had said the 165 is where you'd be happy buyers. We are still collecting a good chunk of change for that, 195. And if you did join the ask, you could get somewhere upwards of 243. Of course, this is after hours, so you'd have to wait for the pricing. But the idea is you're still getting a good chunk of change on Microsoft for saying that you'd like to buy the stock at 165, which is much lower. But you also notice that if you extrapolate that to where our actual pricing is, that this put has increased in value 75% over the past 5 days. And for the past 5 days, let's see if that's actually a good measure for Microsoft. So that would be 1, 2, 3, 4, 5. That's not really that good of a measure in Microsoft, right? I'd like to see where the puts have increased the most in the past 2 days. So let's go ahead and change that. We come back to trade. I'll open up this customized formula. This is the same customized scripts. And we'll change this 5 to a 2. And that should now help me find the opportunities where the puts have increased the most in value in this recent sell-off where, hey, if I sell those, I'm getting an even juicier premium. I'm selling the more expensive thing. I'm selling the more expensive thing that's increased the most in value that's still out of the money. And so in the case of Microsoft, the place that I think that stands out is your 300. But if you look at your premium there, that's 1 cent to 50 cents. So I would argue that you probably wouldn't get filled there. So let's come down to a place where you're still getting more manageable premiums, but still decent premiums. And that ends up being this chunk right here to me that stands out, right? Anywhere from your 135 up to your 155 has increased pretty drastically in value, right? Your 145, if you're saying that you can buy Microsoft stock at $145 and get paid 41 cents or at least say 55 cents even at the bid ask, right? And then you come in to analyze, that P&L looks pretty good on the most part. If we zoom out, you have to come this far out where Microsoft has to fall below 144.45, which is where you then take ownership of 100 shares of Microsoft per each put that you sold. And if we look at the stock price, 144 takes us to even below our halfback level, right? 144 is well below the 236 extension. If you're saying that I can buy Microsoft stock at that price and get paid currently to do so, that would be a proposition that I'm okay with, especially considering that I don't mind owning Microsoft stock longer term. And I think that becomes the big question here is that a stock that you're willing to own longer term? And if yes, then that's where I'm willing to play this move. And if Microsoft does fall down to here, you can then start to sell covered calls against it and get into this wheel process where you now have this generating income sort of move. And that's where Microsoft, if we did do this selling of the put, came back into the Analyze tab here, you'll notice that the theta on this position is positive, a positive 413 on theta, still a positive delta, but your gamma and your vega are both negative. And so that to me seems to be an interesting spot in Microsoft, selling the 145 put. And even if you were willing to own the shares a little bit more and you wanted to collect more premium, even coming out to the 155, and that gives you a little bit juicier of a premium while giving up only 9 or so percent from the topmost move. And that's still, again, another nice way to play this. Now, let's say that you wanted a more defined risk move. Well, that's where I think if we come back to the options chain here, this time you'd like to have time in your favor. So maybe you come out to the 47 days. Maybe you come out to the next monthlies. The monthlies usually are the more liquid ones I've found. And then you're just looking to buy a call debit spread to try and offset that risk, especially if you come down and you see the IV percentile. You're still at the 31% mark. So while Microsoft has increased compared to what it usually does, I think for the most part, you'd still like to be a buyer if you could. That's where if we try to set up the at the money, this is still less than a 1-to-1, and you'll notice the spread is still fairly wide. So coming out 1 is where I think you could get your 1-to-1 risk reward, the 190 to 195. And if we analyze this position, what that means then is your new break-even price is above a 192.39, which you'll notice is obviously much, much higher than what we were currently at, higher than what the stock price is currently at as well. But you're looking for this move up higher to the 1272, and as the stock continues to move in your direction, you would make money. And if the stock continues to chop sideways, you would still be able to offset some of that theta loss with the other call that you sold. Right? You saw that the momentum on some of the lower time frame charts here still suggested that you should be cautious or at least wait for a little bit more chop, and that's what it implies, and that's why I would be setting up a theta positive position here. Now moving on to Facebook, that should be something similar as well. So in the case of Facebook, same thing, right? We're still on our way to the 1272. Same thing if we ran some Fibonacci retracements. We have a cluster zone of the 221.29 area. If I maximize this cell here, we zoom out, you'll notice that that's the extension of this swing high to this swing low, along with this swing high to this swing low, which are the ones that we still have yet to hit. So I would be waiting for Facebook to hit this level, and then again dropping down to that 1 hour chart, waiting for, the 1 hour chart, waiting for the edge signal confirmation, which we already did get, but I'd like to see us touch here. If you were looking for an earlier move, well, you did already actually get your signal in Facebook. And now if we come back to the daily time frame chart here, and we come back to our squeezes. In the case of Microsoft, again, you notice a bunch of fast compression squeezes, 2 mid compression squeezes, no slow squeezes, but your momentum for the most part here is positive on your near term, but your longer term momentum again starts to fade away a little bit more, right? You see a little bit more red on your 4 hour, your 2 hour, your 20 minutes, sure, and then your 1 hour is a little bit more moderate, and then your daily momentum is still bullish, but starting to decrease. All this to say, again, I'd like to find plays in which I'm expecting more of this chop higher sort of move as opposed to, hey, something's about to start running right now. And if we came to Facebook now, and we come back again to the IV percentile, 33%, and our implied vol here is right around 46, 48%. And so again, I think there's 2 different ways you could play it. One is looking to sell the put one more time. So if we came back to the 33-day options chain first, expand this up higher, we look at the all, you'll notice that, of course, your out of the money puts have increased much more in value, but these are the puts that I'm looking to sell anyways because I'd like to own Facebook at a much lower price. I'm not a happy buyer at 228, but I would be a much happy buyer at these lower prices that we'd be looking at. And here, the ones that stand out, you have the 165, which has good open interest, which has increased 300% in value over this recent down move. You have some of these other ones as well, the 180 and 185, where you can collect juicier premiums. And if we come back to the charts of Facebook, we look at where that halfback level was. That was right around the 180 mark. So anywhere about that 180 mark or below is where I think I'm a happy buyer. And so that 180 takes you to right around that 116, 156 zone with puts that have increased fairly substantially in value. So I think that looks interesting. I would not be looking at trying to make this a defined risk spread or anything of that sort where you've made this a vertical, because to me the risk reward there doesn't make sense. I don't mind actually taking the shares of something like Facebook. Or you could also come out and try and play something similar to Microsoft, where you set out these at the money spreads, where you're looking to have the risk to reward skewed in your favor, at least a 1-to-1. And so less than 250 here for a 250 for a $5 wide spread is what I'm looking for personally. And these are those sorts of moves on Facebook, right? Fairly straightforward, but none of these are the straight buying the call here. If you were looking to buy a call, I think what has been interesting place is using like something like the 1272 to time which out of the money call you'd like to buy to try and keep costs a little bit lower. But again, if you are wrong on timing any of that, that position starts to lose value so quick, especially if Facebook does start to have a correction, right? Versus that put, if we've sold something above 180, it needs to fall all the way to 180, before which my pain, quote unquote, is me buying the stock at 180. Again, something that I'm okay doing, considering that it's a stock that I don't mind owning, right? And that's the underlying basis of this position here. All right, moving right along. So now we have Delta Airlines. And so Delta, if we come into our daily chart first, actually, before we go to our daily chart here, the thing that stands out with Delta, and the squeeze things got reversed here and my platform crashing. But anyways, we have a 3-minute, a 4-minute, a 5-minute, a 15-minute, a 30-minute, a 2-hour squeeze. But almost all across the board, we have positive momentum. And so that's where, to me, it looks like Delta moves higher from here. And if we come to our daily chart, and we take a look at what Delta's been doing, it's recently hit its 1272, its 1618, fell short of its 200, retraced its steps, and if we run the retracement from this swing high to this swing low, which was the first swing in this new uptrend, and we compare what that looks like, we've currently broken past that. We also have an edge signal, but then we gapped higher. And if we come down to that 1-hour chart, you'll notice we do even have the multiple trigger signals with the edge signal on that 1 hour from this level, right? So for all intents and purposes, this trade is valid, and Delta looks like a nice stock that's going to make a move up higher. Something that should stand out if we come into Delta, actually, if we count the days that we have here for that script. So here we'd like to compare, if we were looking at puts, the prices for 1, 2, 3, 4, maybe even 5 days, right? Or 4 days is where I think I'd like to know which put has fallen the most. And so if we come back to trade, and then we customize that script. So let's change this variable to a 4. Click apply. Right, that should be a little bit more accurate. Okay, so now we see almost across the board in the 33s, we have quite a bit of gain in terms of the put value as the puts have decreased. And so now you really have your picking here. There's no real super edge, but if you were trying to find numbers that stand out, you see you have 122, 133, blah, blah, blah. But then you come out and you have your 173, your 154, your 176. You have this entire chunk of change, which looks like the one that's actually standing out, right? It's like this cluster of stocks almost, or a cluster of options amidst this entire sea of some pretty nice high implied volatility with some juicy premiums. But if you do look at this on, say, the actual IV percentile basis right down here, you'll notice we're still at 32%, meaning that there's still quite a bit more room to go. And that makes sense, right? If you looked at the implied volatility on Delta, you would expect it to be pretty high during the sharp move down lower. The airlines haven't had a good time. And now I expect that volatility to start to contract as Delta makes this little grind up higher. At least that's what I think to happen. Maybe I'm completely off there, but to me the IV is too high to really be anything but a seller of premium, right? I'm not really willing to pay 114%, even though that there's a pretty high likelihood that this could go from 114 to even something like 138, 150, and you see it going all the way up to 143 so far for our near-term 5-day expiration. So there's no reason why this can't continue to happen, and this 143 may even increase. But to me, I'd like to still sell that. So that's where that one chunk was interesting, where we saw that higher percentile increase, right? Somewhere between that 21 to 18 zone. If you're saying that you can get paid, let's say, $46 to be able to buy Delta stock at 18 minus 46. And so that would be what, 17.54, something like that. So that takes you to right around this previous low, which is saying that Delta would fall all the way down here. And that's where you would then take ownership of these shares. Again, keep in mind that that's your pain, even though your max loss might show more, because that's then taking your stock price and extrapolating that down to zero. That's your max loss here, right? Otherwise, you're going to be assigned shares at whatever that price is of the put that you sold. And so to me, it's like, okay, are you a willing buyer in Delta? And I believe more in the resurgence of airlines and so on and so forth. I completely agree if you don't. And that's where you may be looking at a slightly different play here that's more defined risk. And that's where I think the next one that stands out is still in the idea of selling premium, trying to have this pin up to this 37 zone, right? And so if we come back to this, the Delta options here, we're trying to sell premium. And so if we use that 37 pin, let's start with the put side first, see what that looks like, because that's where our premiums are higher. So if we're buying a butterfly, we want this to be the body. We want to sell two of these, essentially sell the more expensive ones, right? Or the ones that have increased in value. But now let's see whether or not we're buying even more expensive things, or if we get a chance to try and mitigate that. So if we try and make this say 37, and then we just look straight down, so maybe something like the 34, right? And then if we come out here, and then we try something like, actually, let's just make it equidistant, so 40. That should be a 33-cent debit, which if we come and analyze what that looks like, I'll check this one. That's another one I created, which I think is also fairly interesting. We'll compare them side by side. But so this one is a 33, where if we get a move in Delta up into 37, I expect this butterfly to pay off nicely. It's a fairly cheap butterfly as well. This is where your max profit is much higher, right? You're looking at the 265, but that's only if it's on the date to expiration. And so if Delta continues to rip up higher, it's more of what you see in that purple text right down there, which is more like $16. And now most people, this doesn't make sense for most people with most brokerages if you are still paying commission on each leg, right? Because if you're only making, say, 16 bucks, but with the butterfly, you have, let's say, one, two, three, four contracts times 8 really for your round trip, times, let's say you're still paying the 75 cents that TD charges, that's $6 out of your 16 that's gone just into paying commissions. However, this butterfly starts to become really interesting in a platform like Fidelity, which has free options trading, where all of a sudden now if you're saying you make $16 on a $33 with $0 commission as well, that becomes a really nice return, right? I don't care if I miss this move or I don't time this perfectly, I still get a fairly nice return. And if it does grind up higher and take its sweet time, then of course you've made, or it's taken longer, then you've made more and more money. Your delta is still positive in this position, but what you'll also notice is your theta now is negative in this position, right? Especially at that 33 cents. And then your vega is negative. And so I don't like the fact that you're going to be losing money for each day you're wrong. So let's see if we can twist that. That's where if we uncheck this, and if we make it a kinked butterfly, so that's where you're using the same 37 strikes, but now we go up to 40, and instead of coming down the same 3, we're going down 4, so 33. Then you're receiving a net credit for this trade, at least as of right now. Your max risk on this trade, downside, is $43. You have no upside risk, so if it does overshoot, then that's a gain of $57. But if you do get this pin near that 37 mark, and that's where you can manage this position if you come back to the charts by really just seeing how high is high. And if you do start to get into this zone, you can look at what your P&L looks like as a percentage basis to decide whether or not you'd like to take it off, right? Because you'll notice that this is into expiration, it'll decrease to 57, but let's say if into expiration you were able to still overshoot it, you'll notice that your the purple numbers sometimes exceed even the final days to expiration. That's where having the 17 July, so you're coming out to 33 days out, lets you take advantage of that opportunity where time is a little bit more on your side. Now let's say in the case of Delta, you wanted to shrink that a little bit. All right, so if we come to the 37 here, the part I don't like about this is the volume. So let's switch on over to the call side for the 37. So if we use the butterfly, same thing, let's make it $3 wide, so 34, 40. We analyze what this trade looks like. Close that guy out. And so this one is now a 48-cent debit. If we take a look at what our delta on this position looks like, make sure nothing else is checked. Yep. So that's a positive delta, but still a negative theta. So let's try and see if there's a way that we can fix that. So if we start to skew this down again in our favor, let's uncheck this. Now that's an 80-cent debit, so your max loss is 80. Your max gain is 20 if we overshoot. And then if we're somewhere in between near that 37, say that happens sooner than later, you can make somewhere between 57-ish or so dollars. That's $57 on $80, which to me as a percentage basis starts to become really attractive. That's a 71% return with, say, still that $0 commission where you aren't having to lose an edge as a result of paying per each leg. That becomes a super attractive position in Delta, where now time is more in your favor. This is an 80-cent debit. Think of it almost as the fully 80 cents that you've locked. There is no stop on this position, right? You just get to see whether or not you're above 34. And if you had overshot this move even above 37, you're still making money. And your worst case there is still $20, which $20 on $80, while it's not as great as what your max P&L could be, is still a 25% return. That's your worst case scenario if you completely overshoot in the bullish case, right? And you're not having to do any of this buying the call and trying to perfect timing, at least in that regard, because this is now a theta positive position. So that's how I look at Delta. And then the last one we'll take a look at is ZYXI. This video's gone way over, but hopefully this entire process is useful. So ZYXI, the reason I like the stock before we go to the squeeze stuff, it has an edge signal. For the most part, has a really nice uptrend. It's been on IBD 50 for quite some time. And while I missed this opportunity to enter when you got the squeeze signal, you see that basically on Friday you had an opportunity to re-enter at right around the same prices, which also, if we zoom in, happens to be where that 236 extension is. Same thing, not it hasn't hit its 1272 extension yet, and it's also a fairly inexpensive stock, which I imagine if it has good IV could make selling puts here again really interesting. Should be a consistent theme at this point, which is selling puts to try and get into shares because that in the end still gives me stock, which allows me to again sell premium against it to further reduce my cost basis and get into a way where I've reduced my risk into a position when I'm already a little bit more on the fence about whether or not I'd like to be in the markets. Well, now I'm saying I'd like to own stock at much, much lower prices. Right, so that's one way to look at it. Now, for the options chain, we'll change ZYXI to 1 day before because we'd like to see what the puts have fallen in basically Friday's activity. And then if we look at all of the squeeze information, in the case of ZYXI, what we should notice is more positive momentum than anything else, but it's all starting to slow down, right? And only the 2 hours negative, but really for the most part, all suggesting still bullish. And you have the squeeze on the 1, 2, 3 minute, which all still have momentum above zero, but starting to decline. And then your daily 4 hour and 2 hour, again, which your daily has positive momentum, your 4 hour positive momentum, and the 2 hour is the one that's negative, right? This is the one squeeze to be wary of. But apart from that, ZYXI looks like a position in which you could play this move to the 1272. So now let's set up a few trades on ZYXI. So the one thing that should stand out here is our percentile. ZYXI, we're at 52%. Our implied volatility is through the roof. You also don't have weeklies, and that should already tell you right off the bat, along with the HTB, that most likely we should see an e-liquid options chain here. So if we do open this up, and let's change that pricing script here again to now be that 1 day to expiration. Or 1 day, excuse me, that we'd like to compare. And so we're comparing it to the previous day's activity. Then in the case of the puts, nothing stands out in the 5 days. And that's just too close for me to get too excited. But if you did look at the puts here, if for some reason you are willing to buy ZYXI shares at this current price right now, say on this pullback, well, selling these puts is obviously a much better way, in my opinion, to get into these positions, right? It's increased 15% in its value. It's a wide spread, but say you could collect 65 cents for saying that you'd like to buy ZYXI at 20 when it's currently at 22.19, and on that 20, you further reduce your cost basis by the 65 cents you've collected, and so that's essentially telling you your break even on that is what, 19.35. And if you come to the charts here, 19.35 tells you that you're collecting $65 for saying that you want to be a buyer of ZYXI stock if it falls down to right here. That may very well, for many of us, be a decent proposition if you believe in this as a company. Right now, if you come out to the 33 days, again, this is where you want to have to own the shares. You'll get some more data since we are actually able to compare it. Again, this script is relying on the options data, which relies on volume. So if we don't have any closes, then you'll see you oftentimes have this loading error because there's really no volume that you can compare it to. And that's why you'll see there's no numbers for all of it, but the more liquid of an options chain you go to, the more green or red numbers you'll see because the more or less we're exceeding that plus or minus 50%. So here in the case of ZYXI, you do see that this has only one open interest, so that's not exciting. Something I want to skip. That's something I want to skip. But this has has gained 95% of its value. Has 97 open contracts with a volume of 14. So you know it trades. It's the 15 expiring 33 days from now. And so if we see what that looks like, so that's saying collecting $60 for something that's now about to start increasing the time decay curve, right? In 3 days, it'll hit what is that below 30-day mark in which you're seeing that theta accelerate. And you're also collecting $60 to buy the stock at $15 minus $60, 60 cents, excuse me, which is $14.40. That would be your break even on that stock, which takes you to between the 50-day support, the 50-day simple, and the 200-day simple, right? 14.40 is somewhere right around here with the stock price trading here. If you're saying that, hey, would you be a buyer of ZYXI, a stock in which you're seeing a lot of bullish squeezes, you're seeing it's on IBD list, so essentially what you would consider more the institutional players, more volume, more old school approach. Well, then that would be a fairly nice play if you're saying that, okay, yeah, I'd love to buy the stock at 14.40. That's in fact where previous resistance was, access support, and I would be a happy buyer. And if you're saying I can collect $60 for doing that in 33 days, well, that to me ends up becoming a much better way to try and build a longer term position into ZYXI in itself. Now, say you don't believe in this company, but you just like to play the squeeze. So that's where I think you can, again, try and use either something like the butterfly. You want to not be a straight buyer. At least I wouldn't want to be a buyer of just the calls right here. So even if doing something like buying a call debit spread, if I can try and get that skewed in my favor where I have a better than one-to-one risk to reward, which in this case you should notice I don't, right? I can lose 155, I can make only 95. So let's go ahead and bump that a little bit more. So if we come into our simulated trades here, instead of the 20, we come out to our delta 55, and so we do the 22.5 and then the 25. That should be a 70-cent debit. Again, these are like the lower risk plays. They're purposely lower probability, but this is where you're looking for setups that are higher probability and then finding some of these lower risk plays to participate in them. That's where you've paid $70. That's your max risk to try and make 180 if the stock price is above 23.17 by expiration, 23.19, right? And if we come to what that looks like, we expect it to get to 26.1. So while yes, 23.19 is above the current stock price, that's an amount that I feel confident that, hey, if I am right in this position, then I would have made more than I've risked to be right in that position where you skewed the risk reward along with having a setup and an edge in which you see this going. Another thing that I think ZYXI has going for it is the short interest percentage that it has, which is still in double digits. It's at 18.86%. And to me, that again suggests that you're likely to have this rip up higher sort of move, right? Where you very well may target. So these lottery type of plays start to make a lot more sense to me instead of trying to just, play the call and buy something that is at, what is this, 115% IV. That to me, I don't care if it's Delta 60, Delta 70, I don't care how cheap it is. I know that I'm already overpaying for it. And another way to, again, look at this, let's just end on this note, is I'll include this in the script, but if you'd like to see how expensive the option is relative to the stock price, we'll just change this to condition just to be able to compare what the price looks like. So if we click OK here, that should tell you that this option is trading for 10% of its stock price. That's insane if you take a look at that and you compare it to something like, say, a safer stock. So say like a Microsoft, right? If you look at the same options chain, I think we were in the 33 days. This is something closer to 4%, which the IBD rule is the at the money should be at 4% or less. And even Microsoft, the fact that it's hitting 4% to me is a sign in itself. And if you look at SPY for your bearings, and we come out to the same 33 days, and maybe we'll just do the 14 days. You'll get that custom. You'll see that this is 3%, right? At the money, which is less than that 4% mark. And so that's where you can also start to use the second part of that script to gain just the relative scale of how expensive is this option compared to stock. Very simple calculation, but just so often when you're scanning down the option chain, when you're going down the option chain, it's useful to just see these percentages instead of trying to calculate off of your brain, 1049 into 304 is X, Y, and Z percentage. So hopefully this script should be useful from that regard. And I hope this overall deep dive into at least how I look at options, writing the script, seeing how we can use the script, and going through 4 different stocks and their actual options chains was useful, or at least a useful exercise, and gave you some insight into how I approach this, and at least 1 or 2 takeaways that you may be able to apply into your own trading, if it's even if it's just a script at the very least. All right, hope this helps. Take care. Have a great rest of your weekend or the close to your weekend. Relax, and we'll see you in next week's trading activity.